Welcome to the B.F. Anderson Technical Report for February the 3rd. We're hearing so much talk in the media about the Fed raising interest rates and so forth, so I thought this chart was interesting. So what happens after the first rate hike? So we're getting ready to see the Fed, supposedly in March, is going to raise interest rates for the first time in a long time. So I went back to this graph goes back to 1983 and takes every first hike since 83 up until 2015. Then what did the market do 3 months, 6 months, 12 months later? Well, the average gain 3 months later was about 2.7%. The average gain 6 months later, 7.5%. 12 months later, 10.8%. So, it's interesting to note that, with all the concerns about interest rates, you can look here on a long-term basis. I've got a graph here that takes the S&P 500 all the way back to 1980. You can see that since 1980 till the year, since 1982 to 2000, the market climbed 1,146%. And during that time period, the Fed raised interest rates 32 times. So rising interest rates are not necessarily the end of the world. Now, let's just kind of look at what's going on. Again, the NASDAQ continues to struggle. However, it does look like we're trying to put in somewhat of a bottom here. We got a rally off of it, then we got a follow through, and now we're getting another follow through. So things are looking better. 35-week moving average continues to be a challenge. This could end up being somewhat of a resistance area. However, the NASDAQ is taking the heaviest beat, and you can see it here because as we go into the other indexes, you can see here the mid caps have somewhat bounced out, got above that base, still struggling. New York Composite, somewhat of a breakout here above that base. Really want to see these indexes start to stabilize and get back into an uptrend. Here's the small caps continuing to be a problem area. No breakout, continues to struggle within the base. Again, it does look like a base. Now on the S&P 500, which is the strongest index, you can see here has broken out of the base. A major rally, follow through, and then another follow through, actually getting back above that 35-week moving average, which is a very healthy sign. So the S&P 500 is definitely leading the way. On the yield curve, we continue to see an uptrend in the long bond versus the short bond, which can be considered inflationary. I do think inflation is an issue here. Now, on the aggression index, we have seen an upturn. However, we need to get a buy signal, which would get us back above that 40-week moving average, and the 40-week continues to turn down as long as the ratio stays down here. Now, on our three economic indicators, interest rates are flat, still hanging around the 1.8 area. Oil prices continue to stay in an uptrend. I mean, we're challenging $90 oil here. Financials, along with interest rates, are somewhat moving sideways, a little bit of a bounce. New lows do look like they're starting to settle down a little bit. We want to get down below about 40 a day. We've been really spiking here January was one of the worst Januaries in history. So you can see all the new lows that kicked in. Now on the on the sentiment readings, we're definitely seeing some pessimism in here. Now, as a contrarian, you would use this primarily as a buy signal, which means that everybody that wants to be bearish is bearish. In other words, we're getting readings down here of minus 29.8, which is one of the lowest readings we've seen in the last 5 years. So the main thing to understand here is that there's a lot of fear in the market. We can see here that the institutions are actually starting to buy puts to hedge their portfolio. We've gotten into fear here. This is a buy signal on sentiment. However, the issue here is the market oversold? Here we have the percent of stocks below their 200-day moving average. We broke below 25, got all the way down to about 14.9. We've bounced back to about 21.14. You can see this kind of looks like a oversold bottom. Hopefully this is an oversold bottom. Now, if we go back through history, I just want to take a minute on this particular indicator. You can see here that the market usually makes a bottom when you get these extremely oversold readings, because I've gone all the way back to 2003 and showing when we got readings like this, like we're getting now, It usually indicates some form of a bottoming process. Now remember, a bottom in the market is not a point in time, it is a process. Volatility index, very interesting here. What we've seen here is where volatility really spiked. Now what I have here is a rate of change over 10 days. You can see that when the volatility index goes up by 50% within a 10-day period, it usually says things are just getting a little too wacky. You can see here the VIX is really pulling on back again. So again, this could be an indication of a bottom. Now here are the top 5. We've got marine transportation, which is Zim Integrated Shipping. Stocks in a pretty darn strong uptrend after pulling back, holding the 50-day. Now, you know, some people compare these types of formations. They'll say you either look for an egg or a tennis ball. So an egg would come down and break, whereas a tennis ball comes down and bounces back. So this particular situation looks fairly strong. Energy stocks dominate top 5. You can see here with the PDC Energy Group, we broke out new high, somewhat of a little pullback today. We're also seeing Devon Energy continuing to consolidate this gap up. Energy stocks continue to look very constructive. Halliburton, I mean, this is the service side. You know, are they drilling again? Kind of looks like the market's discounting that. We got a gap up, holding the gap. We've been holding this gap now for 1, 2, 3, 4, 5, 6 days, which can be important. Marathon Oil, which is more of an integrated company, which means refining, broke out, hit a new high, continues to look constructive. So that's it. If you have any questions, please give me a call. Thank you very much.